So, guys, welcome back to our weekly live event. It's Pascal here. And so this week, we have a lot of stuff to go over, a lot of good stuff to learn. So, glad to see everybody back here. Really important things that I've seen going on while I'm reviewing people's tax returns and financials. So, what's up, Efren? What's up, Santos? It's good to see you guys. Thanks for all the love. What's up, Blake? Good to see you again. What's up, Spray? All right, guys, remember, you want to ask some questions, throw it into the question section. I'll make sure to answer your questions. Good evening, Richard. Nice to see you. So again, today's class is going to be a really good one, in my opinion. It's going to be a really good one. All right. So today is going to be a good one. So what we're going to talk about is, one, I'm going to talk about 3 different topics. I'm going to teach 3 small little lessons that have major impacts. Okay. One, about should you do a cash out refi, and at what percentage and what value is there a better chance for you to do a cash out refi? It's going to be financially more beneficial for you. The next thing we're going to talk about is how you should not file your tax return if you're doing a real estate flip. And the last one is about the type of insurance you should have on your rental property. Right now, I've been doing a lot of refinances. You know, interest rates are low. It's a great opportunity. Fees are constantly increasing, so it's a great time now. And I think the market's going to tank. So I think it's a great time right now to do refis. But what I've been seeing is that some of my followers have been asking me to do the refi. I've been working on the refi for them, saving lots of money. You know, we're going from 4 to 5% down to like 2.69%. So while I'm reviewing these tax returns and I'm reviewing these, the tax returns, their home insurance, and I'm reviewing their options, I'm seeing a lot of mistakes. And these mistakes are small, but they're costing people thousands of dollars. So what I'm going to do is I'm going to go through them today and make sure that you guys are not wasting money, that you guys are saving money. So my goal is for you to increase the amount of money you are saving and increase the amount of money you're making, so you can net out. That net figure is fatter and fatter. All right. So again, the more money you save, the more money you make. All right, so we're going to give it one more minute for everyone to kind of jump in, and then we're going to start the lesson. All right. Nothing serious, but if I worked as a McDonald's janitor, how much would I make in 5 weeks? I think a McDonald's janitor makes at least $10 an hour, but there's some states that pay $15 an hour. Working 40 hours a week, that's $600. Minus your taxes, you're probably going to be around $150. You make $450 a week, $450 times 5, you're looking at making $2,250. But I don't think you guys are here to ask that type of questions. All right. So I'm about to get started. This is going to be good stuff. So kind of like hone in, focus. It's going to be good. Afram says there's no audio. Anybody else having an issue with no audio? Can someone send a message if they are hearing the audio? Anybody? So official little K. I'll add you after my live, after I'm teaching my lesson. So audio is fine. Anyone that's audio is not working out for them, maybe you want to log out and then log back in. Increase the volume on your phone. Those are some other options. All right, so everyone's saying audio is good. Awesome, awesome. So thank you guys for going back and forth with me to help make this class better. So first thing we're going to talk about today. The first thing we're talking about today is when is it a good time to flip from just doing a conventional refinance, which is rate and term refinance, to a cash out refinance. Today's market is very different than what we've experienced in the past. So it's going to be a little different here. All right, so now that we had distractions, we've removed the distractions. Now that we slipped back the distractions, we're gonna go through the lesson. So when should you cash out refi and when should you just do a regular rate and term refi? So it's really based off of the numbers. So right now, I had a scenario where a client, all right, let's fix that. All right, so I had a scenario where the client, dang, this is like dark. Sorry. All right, that should help. Not at all. Not at all. What the heck? All right, so did that help? That helps some. Yeah, there it goes. All right, so I had a client, they were thinking of maybe doing a cash out refinance. So regular refinance came in at, the property was worth $330,000. I'm gonna try to make this bigger for you guys because I know sometimes it's hard to see. The property came in at $330,000. And right now, on refinances where there's cash out involved, the most they're gonna give is 75%. Which is roughly $250. Now to get $250, he currently owed on the property $225,000. That's a different. He would get about $25,000 out on this cash out refi. This is making things very difficult today to do a cash out refi because the maximum you can do is 75% now. In the past, you can go as high as 80%. So on a cash out refi only being limited to 75% and getting $25,000, sometimes that would be a very good option, very good opportunity. The issue today is that for you to do a cash out refinance, you're basically paying 1.5% up to 1.5% in additional fees to do a cash out refinance. So that means not interest rate, he could still get the 2.69 interest rate, right? 2.69%, which is awesome. But you'd be paying an extra 1.5% in fees. So 1.5% in fees, that's roughly about, in this scenario, we're gonna say 44,000. I'm gonna say about roughly $4,500 more in fees to get this $25,000 out. So we're going to round up just to make the math simple. $5,000 extra fees to get out $25,000. You're paying 20% to get out this $25,000. In this scenario, it does not make sense to do a cash out refinance because you're going to be saving so much money in fees by not doing it. Now, I'm not here just to tell you guys. Remember, if you guys see the picture backwards, go on YouTube. YouTube, you can see it good. Thank you, Hugo. 274,000. I'm just doing rough numbers here just to give you guys the idea. Now, in addition to this, I don't want to just give you what you can't do. I'm going to give you the suggestion of what I'm doing to counteract this situation. So now, since financially speaking, it doesn't make a lot of sense to pay $5,000 to get to $25,000. Now, if you had only owed $100,000 and you were going to take out $150,000, then it probably is going to be, in my opinion, it'd be worth paying $5,000 to get $150,000 in cash. But it doesn't make sense for to pay $5,000 just to get $25,000. Because remember, this 1.5% is based off of the full loan amount. It doesn't matter how much cash you're getting. So you have to pay an extra 1.5% in fees at the closing table to get just $25,000. Now, if you got $150,000, it's still the same $5,000 because it's based off of roughly on the it's based off of the actual loan amount. So let's remember that. So since in this scenario 1, he's only getting 25 compared to say scenario 2, if he got 150, it would be worth it. What would I do? Since this is an owner-occupied house, what I would do in this scenario, I told him to do this. Refinance. He currently owes about, I think, 200 and I think it's $25,000 is what he owed. Right now, closing costs with escrows and everything, all the escrows, fees, taxes, prepays, you're looking around like $15,000. I know that's high. I'm trying to overestimate than underestimate. I'm just putting out numbers, guys. So his total loan is $240,000. His new interest rate's 2.69. He was at like 4.5%. So he's saving a lot of money in interest. The payment has gone down. Everything's good on that sense. Now, $240 is what he currently owes. I said, if you want cash out, here's a better way to get cash out without paying $5,000 in extra fees. Currently, I was able to get a home equity line of credit at 100% of my home value. Currently, because of coronavirus, it is harder to do that. But what you can do is get one at like 89.9%. That's not as hard of your home value, which is roughly 90%. That's 27,000, so 297. So the total loan amount you're allowed to have on your loan is on an 89.9% max loan to value is $297,000. Minus 240 for your first mortgage, because what we did is on the first mortgage, we rolled in all the closing costs. You're left with now $57,000, which is more than double than the other option, and you saved yourself $5,000 in fees. Now again, I do have a lending company. The more you borrow, the more I get paid, but I don't want you to waste your money. I want you to make the smart moves, save your money, pile it together, and get ready for your next deal. So in this situation, he saved $5,000. And remember, money saved is money earned. And he was able to get out $57,000 on a home equity line of credit, up to 89.9% of the home value. And most likely the interest rate on this loan here is going to be around 4.5%. Now I am going fast. This video will be up on YouTube in the next week or two. So you'll be able to get it. Some people saying it's muted on IG. I don't know why. Some people can hear it, some people can't. Log off, log back in. That might help. So now, this is a way he saved $5,000. He was able to refi his house to a 2.69% rate. He was then able to cash out, get $57,000 and get a 4.5% interest rate on a home equity line of credit. Now has another $57,000 in his pocket, able to do the next deal with, okay? Now, why this works, why it's important to refinance the first mortgage first. When you refi the first mortgage, you get the lower interest rate, you drop your payments. You are now have a lower debt to income ratio, so you can get the home equity line of credit. You can afford that loan payment. That's what you have to do. You first have to contract your finances, then expand. Contract, then expand. And that's what I'm constantly doing, contracting and expanding. I just sold 2 of my smaller multi-unit properties. I'm contracting my portfolio size. I'm building up my cash, and I'm about to expand on how many units I own. So it's part of the game. Learn it. Now, you don't need to be the expert. You can have someone on your team. You can hire someone like myself to help you with this, but you have to understand the basics of it to know what moves you need to make. Oh, and just so you know, anyone that does a refinance with my company gets my course, Foundations of Personal Finance, for free. And anyone who bought my course, Foundations of Personal Finance, if they do a loan with me, they get credited back the cost of the course. So my goal is to educate everybody to get them to grow, and I want to help them along their growth. Okay. People are being weird. So, hide. Hide. All right. Why the negative comments? I generally want to know what he did. I didn't even know I would follow this guy. Anyway, I teach finance. I own a mortgage company. I own an accounting firm. I own a real estate investment company. I own an insurance agency. So basically anything in numbers and anything in real estate, I do. We fix our own properties. We build our own properties. We manage our own properties. We rent. We evict. We do it all. So I'm in Florida, Tampa. Now, that is this is part 1 of what we're learning today. I'm going to get ready for part 2. Part 2 is good too. All right. So part 2, this was kind of the, so lesson 2. So this was very, let me fix this. All right. So this was very interesting. I had a client, while I was reviewing their taxes for the loan, I was just talking to them about how much money they made, how they made it, how do they file on their taxes. And they were telling me, oh yeah, I made this much money from my job, and I made about $30,000 on a flip, and so on. So in this section, we're going to talk about tax returns and how to not file your tax returns, or what's the improper way to file your tax returns on a flip. So I was reviewing his tax returns, and he was telling me, yeah, I made about $30,000 on a flip last year. I filed it on my tax returns. I filed it my accountant filed it as a Schedule C. And I was like, what? He's like, yeah, I filed it as a Schedule C. I was like, why? He's like, I don't know. He specializes in real estate, and that's the way he did it. And I'm like, that's not correct. So why is that not correct? Schedule C Schedule C is a small business, how small businesses file their tax returns. Now you would think, wait, but I am a small business. I flip real estate. That's not the proper way or the best way to do it. So the best way, so this is why it's not. So Schedule C is if you're like, you own a lawn care business and you're small and you're not filing a 1120S. You have a lawn care business, you're a hairdresser, you're an Uber driver, you're something that's small, but you're in the business of you're doing the physical job, right? It's basically a job, but you own the job. You own the business, you're working the job. That is not the proper way to do an investment. So what happens in a Schedule C, and this is why financially it's a bad idea. So say you have a Schedule C and you make $100,000. And out of the $100,000, you have expenses of $50,000. So you made 50. So this $50,000, the IRS is going to hit you with a tax of 17% for Social Security and Medicare for the employee and as the business owner. So you get basically hit for both sides, 17%. Right there, you're going to pay what? $8,500 in that tax alone. And let's just say you're in a low bracket. You're in a low bracket and you're only paying 15%, which guys, that's really, really low. Reality, you're going to be in 20. So let's be real. You're going to be in a 20% bracket. So if you're in a 20% bracket for your income tax out of 50,000, that's $10,000 in tax. So in this scenario where you made $50,000 in net profit from that flip, you'd owe $18,500 in tax. You gave the government like all of your profit. And if you were going to do this, you should have done an 1120S, which then would have saved you a ton of taxes. That's for another lesson. So I told you what they did wrong. Let me tell you how it should have been done right. Why is it so dark? Oh, that's trash. Anyway, this is frustrating. Anyway. We're going to go back from the top again, just so you can remember where we left off. $100,000 in income, $50,000 in expenses, $50,000 in profit. So how you would handle this is you would not file as a schedule. Give me 1 second. It's just really dark. Still crazy dark. This is ridiculous. Anyway, so to the point, let's get back here. $100,000 in income, $50,000 in expenses, $50,000 in net income. The wrong way was as a Schedule C, or the inaccurate way was as a Schedule C. The more accurate filing would be a Schedule E. Schedule E. It's kind of like when you're buying and selling stock. when you buy and sell a stock on the Schedule E, you put it when you bought it, the date you bought it, so the start date. You then put the end date, and the difference in time will determine if it's a short-term capital gain or a long-term capital gain. Short-term capital gain, you're paying about 20 to 25% in tax. Actually, I'm sorry. It's 15 to 25% in tax. In a long-term, I screwed that up. One second, guys. So, the start date and the end date. So if the start date and end date is less than 1 year, it's a short-term capital gain. Short-term capital gains is 35% in tax. Yes, 35% in tax. Short-term capital gains, less than a year. Long-term capital gains is over 1 year, and that is between 15% and 25% in tax. This is the same way you treat stocks. You buy Apple, you own it for more than a year, you're between 15 and 25% in tax based off of your bracket. Now, that $50,000 as a long-term capital gain on 50K, you're only looking at about $7,500 in tax compared to $18,500. That's an $11,000 savings. Let me repeat myself. As a Schedule C, there's short-term, there's a start date and end date. There's a short-term capital gains is 35%. Longer than 1 year, so long-term capital gains is roughly 15 to 25%. Again, consult your tax advisor and check on what is current market rates because it changes from time to time. This is how you save $11,000. Now, there's one more thing I would do to make it even better than this. So could you make it better than a Schedule C? Yes, because I would actually switch it to something else. I wouldn't even file it as a Schedule C personally. This is what I would do. If the business is only investing, right? You're not a remodel company. You're just buying a property, having someone fix it up, and then you're selling it for more money. You're just an investor. I would have it as a 1065. That way, you'll be at the 15% bracket. You can bundle a lot of deals, and you can have it as an LLC to limit your liability. Now, if you're actively participating in these deals and you're managing the project and things like that, 1065 wouldn't be very accurate or best. The most accurate one would be an 1120S. An 1120S, your income is at 15% as well. So you can, if it's short-term or long-term, it doesn't matter. It's still 15%. It can get higher based off of how much money you make. Now, at the same time, if this is a passive income or active income, it depends, it'll change things. But roughly this 15% goes to your personal tax return. If you have other dividend, or not dividends, let me clarify. If you have rental income from rental properties that are in 1065s that are also passive income, and you have a negative number because of depreciation, that negative number from depreciation will write off the positive number from 1120S from your flipping. They're both passive activities. So in that sense, you're now washing how much money you make. So the answer is, how did Trump only pay $750 or in taxes? These rules. Not very difficult for someone that knows what they're doing to set up. Again, I was being very quick with explaining this, so I know I got a little jarbled, but this is a very easy way to take it up to the next level. Someone says, how does it feel to be rich? Feels comfortable. Feels nice. Yeah, you should try it. All right, so insurance. That is our third topic for tonight. So I had a client and I was reviewing her insurance policy. All right. So I had a client and I was reviewing her insurance policy. And on her insurance policy, it was lots of comments. A lot of freaking comments. So I was reviewing her insurance. So I had a client. I was doing her refinance and I was reviewing her insurance policy. And I noticed on the insurance policy for her rental property, I was looking at her liability coverage. So for everyone who doesn't know, what is liability coverage? Liability coverage is coverage on your insurance policy that covers you if you are liable for some type of loss. Now, the liability coverage will protect you even if you are not liable, but someone sues you anyway. So if someone's going to sue you for something related to your property, the liability coverage will actually give you a lawyer to defend you. And then if you lose the case, they will also pay up to a certain amount of money. All right, reported that person. All right. Hide. 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 All right, so I blocked a whole bunch of people. All right, hide. I actually don't even know who those people are. So to the point. Now we're going to talk about insurance. So liability policy. On this policy, the person that I'm talking about, she makes like almost, I think, $400,000 a year. So she makes 400 grand a year. Okay. She has a number of other properties. This one rental property is worth, I think, about $150,000. On this $150,000 property, that's too small. On this $150,000 property that she has in her personal name, her liability coverage is only $100,000. So what does that mean? This is everything she owns, right? This huge amount of money. All of this and everything inside the circle. We're going to say probably she owns like $1 to $2 million worth of stuff. Properties and, financial accounts. And out of all that, she only had $100,000 of coverage on that property. Now you'd think, well, Pascal, even if she lost $100,000 on that property, right? She just loses the property, she gives it up. She only lost $50K. Like, what's the big deal? The problem is when the property's in your personal name, Or if you have an LLC and it's not set up properly, what ends up happening, you don't just lose 50,000, you're exposing everything here, everything. So without having the proper coverage, she risks everything she has. If she gets into a car accident and doesn't have the proper liability coverage, she's willing to risk this rental property and everything else she has. So that's what the crazy part was to me. It's like, how do you make so much, not have the proper coverage, and risk everything you own? It's funny. So I just turned off comments because you guys are being really weird. So now, anyone have any questions? You can put it in the comments section. I'm happy to help. All right. So since IG is acting all weird, I'm going to ask YouTube, see what they have to say. Hugo says fire content. Thank you, Hugo. Teen Ambition says it's good. All right, so I think he's talking about the volume. Hugo also says, I learned about taxes in your course. Awesome. Richard says, it's cool we can see the whiteboard, but what if they did the flip in less than a year, because aren't flips meant to be done fast? So as I said, I wouldn't do it as a Schedule E. I would actually have it set up in a different setup. I would have a legal entity, reduce my liability, and use it for better tax purposes as a 1065 or an 1120S, depending on what's more appropriate for your situation. V says, Pascal, are you rich? How does it feel to be rich? Pascal, I want to ask you this. You're rich, successful human. Why are you wasting time teaching us some stuff? So when I started, I was a 14-year-old immigrant that had nothing. And I had a lot of people that were helpful to me that didn't have to be helpful. And what I learned is if you help enough people, God blesses you. And it's for people who don't understand that, it's a really hard thing to understand. But for people that understand that and have experienced that, realize that God's blessing is real. And I've experienced it many times where I'm out helping people. Sometime later, I end up getting helped. So I've done a lot of educational things for people, helpful stuff, giving advice. And then later, they have some relative that needs to use my services, and I end up making money on something else. So one thing that I see is the most valuable is your reputation and what people say about you. And that's really what it's all about. So people really gravitate and use the people that they like when they need a service, either taxes, insurance, mortgages. So I'm really happy to help anybody in their situation, and because we all want to kind of grow. So that's part of the reason why I help. I want everyone to be successful. All right, let's see if we can answer some of these questions. Great question. It says, how do real estate investors contribute to the economy? So this is a really important question, and part of the reason why Trump doesn't pay any taxes. This is how the government works. 99.5% of the tax code is regarding discounts and credits. 99.5 is regarding discounts and credits. Only 0.5 is based off of paying taxes. So that doesn't make a lot of sense, right? That's the opposite of what we've been taught. let me tell you something else. If you look at a country's tax code, you will see what the country wants, how the country wants its citizens to act. The government wants something done, specific things in the country done. And either you can pay taxes, give the money to the government, and then the government's going to use that money to accomplish those goals. Or two, you can start a business, accomplish those goals for the government, and in turn, you get tax credits. You get deductions. You get discounts. So, how does a real estate investor contribute to the economy? The government doesn't want to be in government housing. The government wants our citizens to provide housing for other citizens and businesses. And because of that, they're going to offer discounts, credits to incentivize those actions. Because if without a real estate investor, I think the number was, I think, like 3 to 5% of the country's like housing, the actual units, become obsolete per year. So if there wasn't real estate investors, who would fix up those properties? If every year 3% goes bad, no one can live in those properties because they're too bad. There's too many issues with them, right? Fire, floods, windstorms, whatever you want to call it. There's a lot of different options for properties to go bad. If there isn't a real estate investor, how would anyone in the country like live? Where would they stay? If there wasn't business owners, where would people work? Just remember, when a small business owner is getting these credits, it's not really them getting the credits. They usually make enough money to pay themselves, and the rest of the money goes to the community around them. The reason we saw the economy pop back up real quick is because the government gave stimulus to the people and to small business owners so they can continue to pay their employees to continue working. That stimulates the economy. That puts more money back into the system. That is what a small business owner does. That's what an investor does. Great question. Richard says, can't have said it better. Thanks, brother. Hopefully one day I can help us make a lot of money. I like that. All right, Hugo says, should I still file 1120S if I own a small landscaping business that makes $100K per year, and will an LLC help me? So yeah, you should still file 1120S, and you should pay yourself some of that money, some of the profit as an employee, and then you can take some of that profit as a return as a business owner. So the IRS is expecting you to do both. Pay yourself some as an employee, and then take some as a business owner as a profit. But yes, that's still acceptable. All right, let's go another question. So I got a question here that says, so when the property you own isn't set up right, you could lose your money when you try to sell it. You're not losing your money. You're just paying a lot of money in taxes. So if you file your taxes in an inefficient way or in a non-optimal way, you're going to be paying more taxes. So if you're filing as a Schedule C and paying all this taxes as a small business owner, well, you're really not a small business owner. You're either an investor as a Schedule E, or you are a investor in, say, a 1065 format or 1120S tax format. You would be able to pay less taxes legally by setting up the structure. So you're not losing money, you're just paying more money in taxes, which again, is kind of like losing money. So yeah, you could be giving up more money than you need to. It's kind of like overpaying. Like you could buy some same quality somewhere else for less money, but you choose not to and you choose to pay more. That's why it's important to have a good accountant or a good tax advisor. Next question is, hey, Pascal, what country are you from and based in now? So I'm from Syria and I'm based out of Tampa, Florida, the Tampa market. Also, what kind of properties do you invest in? I have most of my portfolio right now is in multi-unit residential properties. I am looking to get into commercial and other items, but right now multi-unit residential. All right. Next question is, can you do a HELOC on a property you have a mortgage on? And if yes, how does it work, please? So the answer is yes, you can do it. And normally it's basically like this. Let's just say the property's worth $500K and you have a first mortgage that's $300K. On a HELOC, it's in a second position. And as in the second position, again, if you're watching on YouTube, you can see this better. On the second position, say you got a HELOC for $100,000. It would just be another $100,000 on top. So you pay two separate loans, one to the first company, one to the second company. And in this scenario, you would still have 20% left in equity. So it would be a conservative situation. So it's likely for you to get approved. Is a $1 million PUP sufficient or more like 2? So it depends. So Fredos is a specialist in insurance. Thank you for joining us. And it depends. So there's rules, and I'm gonna go over it real quick. It's pretty basic. And so let's just say you make $100,000 a year, or we'll say 200,000 to make it simple. Say you're making 200,000 a year, or you're a doctor, or you're going to medical school and you're gonna be a doctor, and you're gonna make $200,000 a year. Being that you're gonna be a doctor and you're gonna make a lot of money, is important to have a lot of liability coverage. Because if you get into an accident while you're going to medical school, and then you have a lawsuit against you, and now you have a lien against you, once you become a doctor, they're gonna be taking that money out of your paycheck. When you are sued and you are liable, they're gonna take the money out of your paycheck if they can grab it. So if they find out you're a doctor, they're gonna grab your money, and you're gonna be paying money like you're paying child support to this person that sued you. So income-wise, 200,000, the rule is 10 times. 10x. So if you make 200,000, your coverage should be 2 million. Okay? Then there's another way to measure it. It's the asset measurement. So it's your total assets, top assets, minus liabilities. So let's just say in this scenario, you have $700,000 in assets and liabilities. The rule is 3 times. So 2.1 million of liability coverage. Those are the two scenarios. Now, you might say, Pascal, $2 million of insurance, that's a lot of money. And if you haven't shopped insurance before, $2 million umbrella is like $600 a year. So if you're making 200K, or if you have 700K in assets, $600 a year for having a lawyer on retainer. Basically, it's like having a lawyer on retainer, meaning if someone sues you, they're going to give you a free lawyer to protect you. And if you're found guilty and you owe the money, they'll pay up to $2 million in this scenario. Now, again, this doesn't mean you can rob a bank and shoot someone. They're not going to protect you for that. But they're going to protect you if you make a mistake. You're in a car accident, you crash, you kill someone in the car accident, someone's on your property, and somehow, God forbid, it catches fire and someone dies in the fire and the family sues you. That is what it protects you from. It will pay the family on your behalf. So what do? I have LLCs within the companies for one layer of protection, and then I have the insurance policies as a second layer of protection. So I have multiple layers of protection like armor to make sure that, hey, something bad happens here, the insurance company is going to pay you, and the LLC blocks them from trying to come after anything else. Now, I just went to a event. They didn't even teach anything close to what I just taught right here, and it cost thousands of dollars. And you got all this for free. Now, if you think my course, Foundations of Personal Finance, I think it's like $495. It is 8 hours of back-to-back content. Anyone that took it will tell you it's great. And if anyone takes it, and when they're done, they come and get a mortgage from me, a refinance from me, a purchase loan to buy a rental property from me, I'll credit you back the money that you paid for the course. It's really a win-win. My goal is to help you guys become financially free, either buy your own properties and I can help you with it, help you with the taxes, the insurance, the mortgages, or if you are those type of people that make hundreds of thousands of dollars or have a large family and are too busy to do these things yourselves, you can always invest with us. We're happy to bring people along when we find good deals. FYI, we rarely find a very good deal, so we're super selective because we only find high quality properties. Guys, let me see here. Okay, SoCal says, I think only people that have made it already help people out. Others act like they are better than everyone and don't want to help you. They act like the information they have are secret launch codes. Do you do umbrella insurance in California? I don't do umbrella insurance in California, but probably the best place for you to get an umbrella policy is from the same person you're buying your auto insurance from. So if you have your auto insurance with, say, like Travelers, get a Travelers umbrella. If it's Safeco, get a Safeco umbrella. But SoCal, I want to say something before I let everybody go. When I had nothing, I helped people. I helped them with what I had. I helped them with what I could. So don't think you have to be somewhere to help people, because what you're measured with a little, that is what you're measured by, and how you handle the little that you're given is what determines you get more. So when someone comes to work for me, I've had people come to work for my secretary. I'll talk about my secretary. She came to work for me. She was my secretary. She just had to do bookkeeping. She had to do basic stuff. Right away, she was hungry. She wanted to do more and more and more. She didn't know who I was. She didn't know how many followers I had on IG. She didn't really know about all this stuff. She knew that on Google, I have a very high rating, great customer satisfaction review, but she didn't know everything that I had involved. Just she knew that she was going to come work here. She wanted to work with a company that had high reviews and, was an ethical company. She worked hard. And within 3 months, I put her in charge of basically everything. Everything that I touch, she's in charge of. She's managing the property. She's doing the books. She's managing multiple aspects of my business. And we're setting her up to grow. She came and worked hard because she wanted to work hard. She gave her all. And when she gave her all, I gave her more. And I gave her more. And when she needed something, I helped her out. She didn't ask, I offered. Because when you see someone do for you, you're going to do for them. Now, have people in the past abused my kindness and thought it was weakness? Yes, it's happened. But you can't change yourself because of how a couple of bad people treated you. You still have to go out and do good based off of your faith, and God will reward you. And everyone, and I mean everyone who's done wrong to me, I feel bad for the type of things that have happened to them later. I just let it go. I said, you know what? It's going to come back to bite them. And it does come back to bite them hard. So don't worry about trying to get people back. That's one big thing I do. I don't get back on anybody. If a tenant doesn't pay me my rent, I evict them and I don't go after them for the money that they didn't pay. I let it go. My focus is just to get the property back, fix it, and rent it out to someone else and move on. My mind is focused on positive and moving forward. It's not about negativity and fighting the people that took money from me or did something wrong. I'm like, all right, what did I lose? $1,000 in rent? I'm going to go make $100,000. I'm not going to waste my time trying to worry about that $1,000. I'm going to go focus on making that $100,000. And then, oh, I lost $5,000 here. Well, I'm going to go make $500,000. And now it sounds funny and it sounds crazy, but that's really how it was. And that's how it is. So focus on the big things. You're going to get rewarded for that. Focus on the little things and you're going to get exactly what you're looking for. God bless. You guys have a safe night, and I'll see you guys next time.